Looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. Cleo asks, I know the Fed met a few weeks ago and they said they're not going to be moving rates for a while. So, why are people saying that rates are going to go down? It's a great question, and it's important to understand why there's talk of interest rates potentially falling despite the Federal Reserve's recent decision not to move the short-term rate further. So we'll dive into this, but we're always going to focus on how it impacts income investing and retirement planning. So firstly, while the Fed's stance on short-term rates is crucial, the dynamics of long-term interest rates are influenced by broader market expectations and economic indicators. So one factor is the market's assessment of inflation trends and economic growth prospects. So recently there's been a sentiment that inflation is moderate, or moderating, suggesting that the potential, soft landing scenario that we always talk about, where the economy can continue to grow without overheating, right, is, in that scenario, the Fed may not find it necessary to, lower rates or to stimulate growth, which in turn could stabilize or even increase long-term rates. Now, the relationship between short-term and long-term rates also plays a role. Historically, short-term rates have been lower than long-term rates, reflecting the market's anticipation of future economic conditions. However, there's, confidence that short-term rates won't decrease, too much further. The long-term rates may adjust upward to maintain this relationship. So this adjustment is what we've seen recently with the yield on the 10-year government bond moving based on inflation sentiment. Now, other considerations is the global bond market landscape. Despite, credit rating differences or differentials among countries, the yields on U.S. government bonds have often been higher than those of similarly rated bonds in other countries. This global comparison highlights that local economic factors and market perceptions heavily influence interest rate movements, often independent of credit ratings alone. Now, for income-focused investors, especially those planning for retirement, these fluctuations in interest rates, they're significant. Higher long-term rates can impact the yield on fixed income investments, like bonds, potentially offering better returns over time. However, it's crucial to navigate these changes with an understanding of your risk tolerance and income needs. Balancing investments between short-term stability and long-term growth potential becomes pivotal in achieving sustainable income streams during retirement. In summary, while the Fed's decision not to lower short-term rates, it signals some stability, market forces and economic expectations continue to shape long-term interest rates. So as an investor, staying informed about these factors and their implications for your portfolio is essential for making informed decisions that support your retirement income goals amidst changing economic conditions. Great question. Interest rates are always moving. If you'd like to send in a question, you can do so. Email them to poollocke@poollocke.com. So we'll move on to our second question from Bart. And Bart wants to know, should I pay off my mortgage before I retire? Certainly, Bart, that's a question many people grapple with as they approach retirement and seek to secure their financial footing. So we're going to explore it, whether paying off that mortgage before retirement makes sense, especially in the context of investing for income with reduced risk and reduced volatility. Traditionally, there's been a mindset that keeping a mortgage for the tax deduction while you're working is beneficial. Now, the idea is that the mortgage interest deduction lowers your taxable income, effectively reducing the cost of borrowing. However, as you rightly pointed out, this deduction isn't as advantageous as it may seem, especially considering current interest rates and investment opportunities. So, for instance, if you have a 4% mortgage and you're considering using funds from a taxable investment, let's say a CD earning 4%, to pay off the mortgage, you're essentially neutralizing the tax benefits, right? The interest you save on your mortgage payments might outweigh the tax deduction you receive, particularly when you factor in taxes on investment gains. Now, you might argue that you can earn more than 4% in the stock market or other investments, making it seem more profitable to keep your mortgage and invest the money elsewhere. However, it's essential to consider the full picture. Your mortgage payment includes both interest and principal, not just the interest cost. So even with today's higher interest rates, often the total mortgage payment, principal plus interest, exceeds what you might earn on a conservative investment like a CD. Moreover, paying off your mortgage before retirement can provide significant benefits. It reduces your monthly expenses, freeing up cash flow that can, be redirected towards investments designed to generate income, such as dividend-paying stocks or bonds or annuities. This strategy can enhance your financial stability in retirement by reducing reliance on fixed expenses and potentially volatile investment returns. Now, another critical aspect to consider is risk management, right? Eliminating debt, particularly high interest debt, like mortgages, that reduces your financial vulnerability to economic downturns or unexpected expenses during retirement. It provides peace of mind, knowing that you have fewer obligations to meet each month, which can be especially valuable when that income may be fixed. Ultimately, the decision to pay off your mortgage before retirement, it involves weighing various factors: current interest rates, investment returns, tax implications, and your overall financial goals. If reducing risk and ensuring stable income are priorities for your retirement, paying off your mortgage could align well with those objectives. It's a decision that should be made in consultation with a financial advisor who can assess your specific situation and help you navigate the complexities of retirement planning effectively. Great questions today. If you would like to send in your question, love to answer it. You can do so by emailing them to poolelocke@poolelocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me